I took a trade on Saturday actually, and I added to it when it was running, and I just closed it a few hours ago. So, and that's my first like winning, big winning trade of the last whatever few months. And I'm still in a drawdown, but it definitely helps the confidence side of things. But also, yeah, again, it's the emotional aspect that when I have a win, I feel good. But then also like these ideas come, and I feel like I'm onto something. So I wrote some things down, and I realized that I wrote this down last time when I had my big win at the beginning of the year. I think one of the reasons I'm struggling right now is because my strategy is evolving in many ways. I feel like I have no idea what I'm doing, and I'm like, filtering through there's something there because I've got like charts with what these levels, equilibrium levels are clearly, giving some reaction to price, but I don't know how it all fits together. So that's an issue. But then after this winning trade, maybe it's the endorphins or whatever. I'm like, oh yeah, it makes sense. And then so I wrote it down, and then I realized I actually wrote that down last time because yeah, adding in these elements, it's definitely confusing me and making it overly complicated. Like, okay, so now I'm looking at like expectations of macroeconomic events and central banks, So am I like now a macro fundamental trader? Do I care about tech? Why don't I just buy when I have a belief and forget the chart? But then again, if I just trade the chart, am I going to trade something against my view, my macro view? But what I wrote in my notes previously and again recently is that no, I am a technical trader. That's where my roots are. That's what I believe is an accurate representation of reality, the price and how the price is moving. But I think adding on the element of the environment, and in this case, I call it like the macro environment, or whatever, but it's still just the environment of how other traders and participants are looking at things. It can obviously have an impact, and I think there's an edge there. So what I'm saying is, I go technical first, right? I have a very simple like momentum, volatility strategy setup, let's say, or trigger, and these signals come up quite often, right? So before, way back, I don't know, a few years ago, I was just trading that, and the idea is eventually I catch a fat tail. I don't know when, I don't know how. But it has a lot of drawdown, and yeah, it's not clear when the win is coming. So adding in this element where I see that the technical setup trigger, but then I look at the environment, and the environment can be, if I know that in a week there's a hugely volatile, Federal Reserve rate decision coming out, and let's say volatility is low, and I've got the setup. So the setup is saying we're in an environment where this technical setup could get pushed by the external factors, or however you want to call it. And so in a way, it's like saying it's changing the probability of that setup. And it's the way I look at it, because I've explored options for so long, it's giving it it's saying like this bet is like a cheaply priced bet. Yeah. In the same way, an options, like if you're buying options, you want to buy options when volatility is low so that you can capture that move, but also they have an expiry date. So using the event is a kind of way to give you a very clear target, a time-based target. So I see a technical setup, may or may not work, but then, let's say I don't know, it's probably has a 30% chance of working historically. But then I say, okay, it's showing a long bias, and I know there's this huge event coming that's going to bring volatility, and I know that the expectations are for them to do whatever and whatever, which could also increase, and it's in 2 weeks. So, and I can take this trade with a small stop because this volatility is low, so it's like a cheap trade. That makes sense. But it can also be the other way. Like I could say, I know, yeah, let's say price is turning, the momentum signal is showing that we're going to possibly fall. But again, like historically, it's like a 30% chance if you just take a random, 30% chance of catching a fat tail. But if I know there's an event coming and it's like a 95% expectation that this particular thing is happening, but if it doesn't, it could cause price to plummet. So it's kind of saying like this is also a cheap bet because I can take this trade, it's probably going to fail, but if it doesn't, the kind of expectations will push price so far the opposite way, because market participants are on the wrong side. So it's again like a cheaply priced bet. That was a lot of stuff, but does it make sense?
Oh, it sounds like you're basically layering on the environment to your usual setup, your kind of volatility driven setup. But when you say environment, do you also mean you mean fundamentals, don't you? Because you're talking about like
No,
news releases coming out. Or...
Yeah, but I don't like calling it fundamental. I'm calling it expectations of macroeconomic events, right? And in other words, it's basically at the moment, and for the last few years, it's just central banks.
But it's not technical analysis, is it? It's not price volume. It's like events. Isn't that fundamental?
No, but I'm saying like the technical is the momentum strategy. It's basically just higher highs, lower lows, right? So I see like higher lows, for instance,
and you start with that, yeah.
I start with that. I say, okay, signal. And then this is what I'm realizing now, right? So then I go and look at I already have it marked on my chart. Like in 1 week, there's going to be a CPI. In 3 weeks, it's going to be Federal Reserve. Then I'm also like reading, some research papers of what people are expecting and what they expect, what impact that will have on price. Here's an example.
Is that not fundamental though? Why don't you call it fundamental?
Because I wouldn't, for example, I wouldn't say, okay, Federal Reserve is going to decrease interest rates. That's good for risk assets. I'm going to buy Bitcoin. What I'd say is people expect the Federal Reserve to increase interest rates, but I'm getting a signal to go short. So if they don't increase interest rate or whatever basically they expect, I'm messing up the actual fundamentals because I don't understand them. But I'm saying if I know from all the research and the positioning data and the general, stories around the internet that people are expecting one thing, but I'm getting a signal the other way, then again, it's saying like, I'm probably wrong, but if I'm right, the risk reward is incredibly high, or the other way around. Like maybe the technical is confirming the hypothesis of the market that, the Fed is going to do one thing, and but usually it's like before the event, it's like pricing in, because that's how market participants tend to react to these events. They're not saying like, oh, it's a fundamental view, I'm going to buy. They're going to say, oh, I think this is going to happen in the near future, so I'm going to position myself now. That's where all the concepts of like things being priced in, and you often see these moves happening before the actual event, so it can be represented technically. So that's why I'm trying to say that it is technical. I wouldn't take a view based on fundamentals alone.
So you're kind of using the fundamentals to get your timing down, or to understand market sentiment more than what the actual numbers are going to be. I don't. For me, just the way I look at it, there's technical analysis and there's fundamental analysis. Technical analysis is easy to explain. It's just the charts, the price, the volume, the patterns, the plays, the setups. And there's fundamentals, which is the real life, what's driving theoretically the price, what the whys, if you like. So that there's only two things. So if it's not technical,
but they're both connected, and this is a point I tried to make last week, that I believe that sometimes one drives the other. It's not like technical analysis is the only thing, because like you just said, they're both two sides of the same coin, right? So I believe that sometimes the technicals, like if Bitcoin is exploding higher, then it affects the fundamentals, and it's been proven before. Like, yeah, when Bitcoin, it was in its bull run in whatever year it was, 2000. I don't remember the year, but
17, 18.
yeah, let's say more and more money was going into blockchain technology, and like, and it changed the narrative, and that fed back on the price. Usually it's probably the other way around, like there's a fundamental narrative and that feeds the price and affects the technicals. But yeah, it's for me the technical, that's why I've been saying, like, I don't really believe in technical analysis, but I like the idea that it's a risk management tool and it can be confirmation of a hypothesis. But I'm kind of going both ways in terms of like getting a signal. Okay, let me give you an example of what happened, right? Because I'm marking up these equilibrium levels. So every time an event comes out, after, yeah, you say it should be more precisely defined, but after a few hours, I'm marking up the equilibrium, right? And then I update it every other day, like to see where the new equilibrium is. And what I realized recently is, like when Bitcoin was dropping, it was making lower lows, like on the daily, on the weekly. But then, like every time a new event came out, the equilibrium level would rise. It was like slowly rising. And then when I saw the higher high coming on the daily, it was like confirmation that you got convergence of the fundamentals and the technicals. So I'm going to buy. And yeah, it worked in that sense. But my conviction was very high because of those two factors. Right? If I just bought the high, it would be like, okay, but I wouldn't just say, oh, the equilibrium's, rising, that I think the price is going up for fundamental reasons. It's because of the technical. I saw the lower low failed and a higher high was created. So that's my technical confirmation.
Yeah. I don't know. I'm not fully following, like, because I don't know, maybe I don't understand fundamental, like, so it's not, yeah, so it's not fundamental, it's just like you calling equilibrium level.
Yeah, it's just the name I've given it to it.
That's on the technical
look,
side though, right? That's
well,
chart based.
yeah, I'm looking at it. Well, no, because I'm saying that the input is the real life fundamentals, as you put it, and it creates price action, right? So I'm marking that off, but I'm also marking off like what it was and what future events are and what the expectations are and how that could affect price too. You know what I mean?
Okay.
I mean, this is all inspired by George Soros, and he has this theory of reflexivity thing that the fundamentals affect price and price affect fundamentals and there's feedback loops. And he has a few quotes, and I paraphrase it because I realized it was basically the same thing. What I'm trying to do is trying to do what he said. And I don't remember the exact quote, but he said something like, markets are just a series of events where like there's some narrative or idea um, that feeds on itself, and then until reality catches up with it, and then it all comes crashing down. So, and it could be a technical thing, and it could also be a fundamental thing. But the point is, it's that element, and also the options. The fact, like options, you're looking, if you're buying options, you're looking for them to be cheap, and cheap comes from the volatility, but also you've got the cutoff, the expiry date, and since markets are like forward looking, they're trying to predict the future, right? That's the whole point. So you can make assumptions about the impacts of what the future could have. And when all the factors are together, like low volatility, technical confirmation, and upcoming potential volatile event with, and let's say skewed expectations, then it's like A plus, because the odds are on your side, the risk reward is on your side, and it's cheap, like, to perform or to execute.
Yeah. It is a bit complicated, but I don't understand what you mean by cheap. I mean, I know the concept of like low volatility is kind of appealing for options, but
Yeah.
if that's what you mean, but
Yeah.
yeah, it's Sounds almost like an investment strategy than a. Well, I guess you're more longer time frame focused, aren't you?
Yeah, well, no, I think what I mean by cheap is in terms of the leverage. Like, yeah, it is kind of like an investment framework, but then if I get the signal confirmation in terms of technicals, that gives me the ability to apply leverage and potentially get an outsized return. Like, and when I say cheap, like, okay, I want to long Bitcoin, but if I use the technicals and I can zoom down and the fractals, I can zoom down and take a larger position with because I'm using a stop loss. So um, it's basically that's what I mean when I say cheap. It's like a cheap way. It's a cheap way to expose yourself. Okay, let's say it's a less costly way to expose yourself to that hypothesis, and you have a framework for testing it. And if you fail, you get invalidation, and it's not expensive because you can say like, I want to own $100,000 of Bitcoin, but I can literally risk, 1,000 to test the hypothesis with my technical setup.
Okay. And it seems to be successful though. Like when you did your trade at Christmas, you were using this same approach or not? I mean, you had your driver, your technical driver, which was the momentum that you talked about and the volatility. But did you not apply this second thing
I
to that?
did.
Oh,
That's
you
the
did.
thing, but I
So you
wasn't
started
sure.
doing that,
I
but
did, but I
less
wasn't
data on
sure
it.
how.
Yeah.
I wasn't sure what the fuck I was doing. It was more like almost like a subconscious thing. Like I'd marked it off on the chart. Like I knew the CPI was coming out, then the Federal Reserve thing. I was reading the reports,
Yeah.
uh, and it was all kind of, it
Well,
was all
that's
there.
why I don't. Sorry, that's why I
Yeah,
don't
go
get
on.
because there's always numbers coming out. There's always like CPI. Was it once a month? Or
Yeah,
and
yeah,
it's
yeah.
like clock. It's literally the same time, isn't it? Or maybe I don't know exactly,
Yeah.
but
Yeah.
so and there's always different numbers coming out. So I don't understand how you can use these events to kind of time. I understand. We're kind of maybe going down this rabbit hole, but it's fine because it's interesting to understand it, and maybe it makes it clearer in your head by explaining it, but to a
Yeah.
dummy. But so you've got your technical drivers like your momentum and your volatility that you use as a primary signal, but you want to layer on this kind of I see it as fundamentals, but you're saying as like the market sentiment or the environment of what's currently going on to help time it and to help give you more conviction behind your approach. But it's just the second part is what I don't fully understand. You're saying there's a CPI number coming out, and I know stuff gets priced in, so you're kind of using that number to kind of time it. But what if there's always a CPI number coming? I don't know. It depends what your time frame is. If it's within the
Yeah.
week of the CPI number, then maybe. But
Well, no, I think that obviously this is a less scientific way because there's less data. It's more about narrative. It's more yeah, about the stories, which is not that difficult to know. All you have to do is go to Bloomberg or Financial Times or any kind of and what are the big stories that keep, it's the same as if you watch the news. Okay, the Ukraine war is a big thing. Like, I don't know, and obviously it's different depending on where you're physically located. But global markets, there's usually one or two driving stories. And that's another factor in this recent trade. Like it was there, I wrote it down, but I didn't know if it meant anything. Like this debt ceiling talk in the US. Like um it was pressuring, like people were saying if they don't do this, like the US economy is going to implode and it's going to be really bad. Nobody knows how bad it's going to be, but it's really so this negative thing. And then as the basically my thinking was, okay, so everybody's expecting it to be really bad. There's a lot of risk. If this risk is settled by the US saying, okay, the deal is done, we've raised the debt ceiling, then it's like the pressure's gone. The risks are, hedges get taken off because the risk positions get put back on. So it opens it up. And if Bitcoin is now like failing to make lower lows and, printing higher highs or higher lows, for example, and I buy on the higher high, and maybe by coincidence, like, okay, it's kind of like saying it just needs a little push. And if I don't know what the result could be, the news comes out bad or whatever, but if the news comes out good, everything's set up there for it's just
Right.
gonna run.
Okay.
It's like
That makes more
balancing
sense.
and
Yeah.
gets tipped kind of thing.
That makes more sense. So you're kind of looking for catalysts, real life catalysts to push your technical setup, basically. Yeah, that kind of makes sense. But also you got to be really careful with that, because obviously you're going down this route of like the mainstream media, the BBC or Bloomberg, and they report, Bitcoin up because of X, Y, and Z, and like it's hindsighting it. But you're doing it, not hindsighting it, but it might be bad news and it might go up. It might be good news and it might go up. So you don't know.
Well,
but at least there's something happening, I guess. That's what you.
That's where the other elements come in. Like you can look at sentiment indicators, you can look at positioning data. Like obviously, I wouldn't only buy good news. Sometimes I'd want to sell good news if I thought the risk reward was better. Like, and obviously that's true too. Like every time I read some news report, it's just ridiculous. The price moved, like Bitcoin dropped 2%, and then they're like, oh yeah, because something in China with some government minister said something about mining. Like what? Where the hell did you even find that? No trader heard about this story before. You've just written it after the fact to give it. But it can go two ways. They're like chasing price, and then sometimes price is chasing a narrative. Like if it's a really big story, So yeah, it's a bit wishy-washy, but well, first of all, I like it because it's actually interesting, and maybe in a sense there's an edge there because it's a bit more elusive, and maybe if you just spend enough time, like reading and listening and kind of taking part, then you get better at reading the narrative. But
yeah, it's definitely going down the route of fundamentals. At least just even if you're just using them as a kind of catalyst, or using. In fact, you're kind of doing it the opposite way of I think what most big investors do. They focus on fundamentals, but then when they want to actually get in, they go to technicals to try and time it.
Exactly.
But you're doing it the other way around. You're doing it the other way around.
Yeah, which I think is fair enough. Or maybe it's, for me, it's. Well, I'm kind of proud of that. That either means I'm a total idiot because I'm doing exactly the opposite of what all the institutions are doing, or it means I'm on to my own thing. Like I'm not just blindly following somebody else's ideas. Because for a time I had that written, like, that makes sense. You have an idea, but I don't understand the fundamentals. That's why I disagree with your analysis. That I don't like the idea. I don't know what the Federal Reserve quantitative easing. I have no idea. I mean, I read about economics, but I don't understand the impact. I don't think anybody does. Because if you listen to a lot of podcasts with economists and macro investors, they say shit and it always ends up happening the opposite. So using the technicals first, it's like the scientific method in the sense that you've got confirmation that probability is on your side, and the other stuff is the catalyst that may drive it further.
Yeah, I mean, just a couple of things. Like the first thing about Bloomberg analysts or whatever, they're literally paid or kind of sponsored to say shit, I think. And there was, again, this was on Chat with Traders. There was one guy that he knows that these analysts, that to mention a stock or just upgrade some stock or just upgrade something for us because we want to get rid of our position on it and we need buyers. That's literally how it works. And I remember last year it wasn't GameStop, but it was another Reddit related thing, and I think these mainstream analysts just made shit up about now Reddit's talking about silver and Reddit weren't talking about silver. You go on Reddit and they're not talking, and there's a thread about how they're not talking about it and they just lied. But all the old boomers or the old investors can't be bothered to actually log into Reddit and check it. They just like, oh, this is the next thing. Reddit is driving the market. Everyone's got their checks and this is what's happening. These clowns. So it's you can't really listen to analysts. And like you say, that they might not it's not that they don't necessarily know what they're talking about. It's more they got an agenda. They've got a conflict of interest. maybe they're great economists, maybe they're not, but also they've got they're paid.
But that's still fine though, because it's still a signal itself. I mean, you don't have to like you said, you don't have to know the whys. If they're saying Reddit's talking about silver, and you know that it's going to have an impact. You didn't know that it's going to be all these boomer hedge fund managers buying silver because they think it's happening, even though it isn't. It's still having an impact. So,
Right.
and I'm not going to like read one story and be like, okay, this guy says gold is going up, so I'm not gonna take the position. I'm not gonna go opposite either. It's more like reading many different, also talking to people. Like you've been bearish Bitcoin recently, and like everybody I follow on Twitter has well, not everybody. A lot of people have been short. So I know that there's probably a lot of short traders.
Yeah, yeah. It's interesting on that note, because
Sorry.
my swing trade, or my big, I kind of oversized my hedge, so I made money. It was basically a short on the swing that got stopped out, and you were probably buying my stop, which I'm now re-entered. I don't know what it's doing now, but I'm just trying to catch the top of where we are now. But at the same time, on Friday, I was trading Bitcoin on my day trading account, and I was longing it. I was looking for longs up to, I don't know, $500. I got in a really nice long, but maybe I should have closed my short on the other account. This is where it gets confusing when you've got two accounts with different time horizons. I
Yeah,
thought,
that's what I was saying last week. Like you got to be very careful, because then they either balance each other out and you leave them separately, or they influence each other. You got to figure that out.
yeah, and
So
I was no, it's fine. I was letting it, but I was letting my long term bearish bias influence me because I my day trading account, I had a nice long, and then I took profit. I left a tiny bit, and I actually flipped it because I thought it was coming back down again, but a tiny flip because I wasn't sure then, and it was getting towards the end of the day. So I just left a little bit still short after we went up to a level, and then that got stopped out eventually, as it kind of went up, but just a small. But yeah, it's tricky. It adds another challenge when you've got two accounts with different time horizons. It kind of brings it home that you can buy and I can sell right now, and we can both be right because it depends on our time horizon. Basically, I could be scalping in the next 10 seconds and then exit, and you could be waiting for a year. An extreme example, but so yeah, and you got to just play them independently, and it's really important. The time horizon is really important.
yeah,
But just jumping back, I was going to say something else on when you were talking about how kind of fundamentals and technicals. Um, yeah, the classic example, I think why people do it the other, or why institutions do it the other way around. Like they might really analyze, say, Tesla or whatever, or Amazon, and they might see the price to earnings ratios and the amount of employees, and there's a new CEO. This company is just fucked. It's going to be doing shit, but it's still going up because the technicals aren't ready yet. But so it's like the fundamentals are there in the background, ready to go, but they've just got to wait for all this enthusiasm to die down. But so what you're saying is kind of the other way around. I don't know how to describe that. You see the technical setup, you're also aware, but you don't look into it in that much detail. But you're aware of potential catalysts that are going to push the move in your favor.
well, yeah. And the way I looked at it though was you've got these teams looking at the fundamentals and studying, and obviously they've probably got a lot of capital that they're looking across either an entire asset classes or multiple asset classes. But I'm one guy trying to become an expert on one thing, so I feel like hopefully I do have an edge, at least in the technicals, because I'm watching the chart every day. I've been watching it for years. The fundamental layer is just, again, I keep calling it environment because I don't know if there's a better way of putting it, but catalyst is another good way of putting it as well. Like it's building up to something, like it has greater potential. This technical setup has greater potential, if that makes sense. So maybe it can change the way I size it, or the way at least it can give me some kind of target. It can give me a time frame, like the time horizon, like you say, it has to be aligned with that, and it can give me that because I can say, okay, in 3 weeks we have this huge event. Also, I can look at where the price was last time that event happened, and what happened last time.
Yeah.
Um,
I it's kind of against my trading mantra. Is that the right word? Like my trading. What does mantra mean? Is that the right word?
Isn't that a meditation? You keep
Like
repeating
belief,
the
but
same thing.
well, not really mantra. It's not really a slogan. Basically, belief or kind of outlook. To look at fundamentals, basically, because this is maybe it becomes more important that you longer your time horizon. But yeah, for intraday trading, fundamentals are not that. But like you
Yeah,
say, maybe the
but this
just
is the
news
thing.
events. Yeah, the
I don't
timing.
see it as, yeah, again, it's not fundamentals for
Yeah.
me is like you say, like PE ratios. It's a very different, it's even a completely different subject. Like you said, like they're looking at Tesla and PE ratios and stuff, but that would be if they were fundamental investors. But if they were macroeconomic traders, they wouldn't be looking at that. They'd be looking at central bank liquidity and are they like printing money and what are the interest rates, stuff like that. It's like technical fundamental analysis, you know.
Okay.
And I think it can work intraday too, because I see like on a fractal level, you still have this, the news is coming out, you have those levels and they react, but more short term. It's just the way I look at it long term, it has more time to play out and potentially there's more profit there. But I've also realized that, again, not many data points, but there seems to be a sweet point, like about 3 to 4 weeks for me. Like those few big trades I caught were around that time frame, and it seems to be like it's like if you go too early. If I say like, okay, in 6 months there's going to be an event, but that's an investment, and price can go up and down and sideways, and then it can take hold. If I say in one day, then it's probably already priced in, like all the big money is already prepared. But when it's a few weeks, it seems to be just around time. Like again, I see that as the risk settling. Like when a piece of news, like the debt ceiling, all the market participants are kind of like holding their breath, waiting. Like we can't take a position, you can't trade $1 million position until you know that. And once it's released, the risk settles. People take off the hedges, and the market starts to breathe and move again, right? And it's the same like as an event is coming up. Like you
Yeah.
can't just say in 6 months the Federal Reserve is going to do this, so I'm going. That's too far ahead. There's so many things can happen. But when it's coming up, you could say, okay, the event's coming up. There's nothing in between, so we can start positioning ourselves for this expected outcome, and that impacts the price.
Yeah. Yeah, that's certainly true. Like you can literally see liquidity start leaving the book before like a main big news event. No one wants to be exposed to that kind of volatility short term. So it should happen on a bigger time horizon as well, I guess. But yeah, it's interesting. It's certainly another layer of complexity. Maybe it's not that complex for you. And
Well,
yeah.
it is though. That's one issue. I'm trying to simplify it, but a part of me, I don't know. Maybe I'm insane. Maybe I'm stupid. But a part of me hopes there is some truth to it because I still don't believe. I don't believe trading it can just be reverse engineered, right? I don't because otherwise there'd be no point in us. You could just have an algorithm, data mine a bunch of stuff, and just like find the best strategy, right? This is why I hope there is some element of discretion, and if there is this idea that like a not completely discretionary gut feeling trading, but where you have some risk parameters, you have some technical setup, but then maybe you do feel something, you see some narrative, you see the sentiment, and you trade based on that. I hope that that's true, because that would be an edge that somebody can't just take away with a computer, or you know
I
what I
think
mean?
I don't know. I mean, there's this weird statistic: the market is 90% algorithms. I don't fully understand what that actually means, because you can get algorithms just to enter a position for a human. So is
Yeah.
it you get different type execution algorithms, or algorithms that are kind of AI algorithms are actually just making decisions for themselves? So it's lots of different kinds of algorithms, or just but yeah, the I think probably is a way. I don't know. I certainly think my strategy can be put into an algorithm.
I just want to say the one thing that I find fascinating, but also incredibly scary. Like you shared that chat with Traders podcast, and the guy said, it's not like poker or other forms of gambling where the odds are known and the probability. The best you can do is estimate it, and in many cases, it's like geopolitics or whatever. Like you can have an idea of what the outcome could be, but you can never test it again with all those parameters. It's impossible. It's happening once, so it's kind of beautiful, but it's also scary, which is why I'm saying I hope that in a way, all that experience and maybe, yeah, there's something else involved where you can't just say, oh, I just plug that into an algorithm and there you go, 6% chance. It's not that simple. Sometimes you're going to be in a situation where you have to make a decision. There's not really that much data to look back at. You don't know what the outcome is, and you don't even know after the outcome, did you do the right thing or not? This is why I'm looking at it just in terms of, is it cheap or not? Is it a good, is the room for error incredibly wide? The risk reward is so good. I don't really know what the probability could be. 55%, 73%, 69.5. I don't know, but as long as it's more than 30%, then the chance, the kind of, it's just so juicy. It's like a juicy bet.
But what? Yeah, this is the next question. Why? Why bother? Why? Maybe you don't need this. Like, I don't know. We talked about this before as well. Like your strategy. Like I heard a chat with traders today, and the guy. It wasn't a great one, but the one thing I got out of it was he said, basically, he's over the years he's basically just become trading. He's realized trading has just become a case of risk management. It's a cliche, but he's become a risk manager, and his strategy is just the same as it was 10 years ago, but he's just getting better at managing risk and making quick decisions based on for example, I didn't do that when this price start when I saw the long on my day trading account and I took it. I didn't change I should have been decisive and taken off my short on my swing account, and I knew it was going up, so why not do that? It's that would have been good risk management because it was going
Well,
up.
no, hang on. I disagree though, because it's a totally different. It's a different trade, a different. You can't base it on the outcome. First of all, what does he even mean by risk? What does he mean by risk management? How does he define risk? Did he mention that?
Not really. Just not take losses like I took a loss. I knew I don't know, kind of being more dynamic. That's what I'm trying to say. More, I don't know. There's some kind of I don't know if you feel this. This is related to hedging when I was talking about that as well. There's some kind of inertia. I'm coming up with words that I don't know what mean. I just want to check I'm using the right word.
Yeah, I do that all the time.
Let's pull them out of my head. Yeah, and inertia. The tendency to do nothing or remain unchanged. It's kind of like you've got it's like a lag or a drag to take action. It's easier to do nothing than it is to do something. So and you get caught like a rabbit in the headlights sometimes because of inertia. Because I'm got conviction about this long, and it's not an insignificant long. I caught a pretty nice chunk of the move, but I just thought, no, I can't. I want to touch my swing trade. Why not? You've got to be proactive and just take it off and then to re-add it when you take profit on your other one.
But the reason I disagree is because there's the idea that your time frame don't mix up this. Make sure your time horizon is aligned. So of course, if you're going long short term, yeah, and the short on the long time frame might still work out. You don't know. It
Yeah,
just
yeah.
didn't in this case. But
But why not just hedge it a
um,
bit? Why not just take it off for this? Because
for the trade, yeah, that could make
just for
some
the
sense.
trade. I mean, I don't know. Like
Yeah,
I
yeah,
don't-
that makes sense because
my yeah, I wasn't gonna just
yeah,
take it off forever, but I put it
I mean
back on now.
that's what I do in terms of like if I'm taking a short trade, I also add on the amount of capital, Bitcoin capital I have exposed, because if I believe the price is going down, why would I not hedge my exchange rate risk? Like, obviously, yeah,
But this is
doesn't
where
always.
yeah, yeah. This is where hedging comes in though. Like, does that get around the inertia problem of because sometimes as well, like I'm getting better at this, and on my day trading account, I'm more dynamic and nimble, and I jump in and out more. But I've only just started getting better at that. Of course, you take commissions, you pay commissions, but if you've got a signal where it's the momentum is still there and it's going through your entry, uh, and my stop is just miles away because that's the ultimate hard stop. But why not just? But I don't want to. The trade hasn't invalidated, so I don't want to take it off because it might start. It might come down, and I miss it. There's no point taking it off. But also, it's not quite ready yet. So what?
Yeah.
So yeah, like do you
Also,
take
in
it off
that
and then put
case,
it
it
back
does
on
make.
again? Like I've
No,
done
in
it.
that case, it would. I think it's quite simple. You have two separate trades, so a long time frame trade and a short time frame trade, and if you get a signal on the short time frame that's opposing the long time frame, you simply hedge the longer time frame, and unless that also gets invalidated, but that's a separate trade. But for the duration of the short time frame trade, you hedge the long time frame if it's opposing views. Otherwise, you leave it on. You could just do like that. And as soon as you close the lower time frame trade, you remove the hedge.
Yeah. But do you not find it hard to jump in and out, or maybe it's not your style anyway? You like this is what I'm getting at. This is my point. Like there's a natural tendency to not want to fuck around too much, even when new information presents itself.
Well, yeah, getting married to the position. Yeah, definitely.
Yeah, there's that psychological aspect as well. But I don't know what I'm trying to say here. Just inertia, trade inertia, just entering a position and just being kind of stubborn with it, even though you can see it's probably going to go down. Well, I guess you never know for sure. That's the problem. I don't know. Yeah.
I'm not sure why, but I had this when you were talking. I remembered something I heard a while back about risk. Like you got to define what risk is. I think that's where a lot of things come from, where a lot of profits come from in trading, because it's people being on the wrong side of risk or mispricing risk and so on. And I remember I listened to this interview, and this is where maybe I enjoy fundamentals, or I have some understanding of fundamentals, because it was a conversation about inflation and whatever. And he said that he was an advisor to some big hedge fund, and this was years back before we had this recent inflation story in most of the world. Well, there was no inflation in the world, right? And the hedge fund said, "What's the biggest risk that we should hedge against or look out for?" And he said, "Should look out for inflation, like suddenly popping up." And and the hedge fund said, "No, that's stupid because the central banks will never let inflation happen, and there's no chance of that." And the guy's reply was, "Well, yeah, but isn't that what risk is? That's the definition of risk, something that's not likely to happen and that nobody would let happen, but could happen. So you need to be prepared for it." So this is why you have to be really careful, because you don't know. Yeah, you took the long, it works out, and you ended up getting stopped on the short on the longer time frame, but you don't know that that was the right thing to do. I mean, you can't say I should have closed the short. That was the right thing to do. The risk were obviously to the upside because it was a different time frame. It was a different. time horizon, and maybe those two strategies are opposing and they balance each other out over time.